Great. Good morning, everybody. My name is SHMUEL BORNSTEIN. That video had nothing to do with my presentation, but I figured it would only be 30 seconds anyway, so once they played it. I'm a senior associate here at OurCrowd. And firstly, I'm thrilled that you came, to listen to the session. I think it is a very, very important session in terms of investor education. And what I'd like to do over the next 50 minutes is go through a bit of, pre-prepared slides, but then really open up the floor to some questions. I know there are a lot of investors in the room over the last few weeks, over the last 4 years specifically, but the last few weeks in a really intense way, I've been getting a ton of questions regarding term sheets. So I'd like to go through some of these terms and let you know how we, as professional investors, look at term sheets and what it actually means to be an active investor in a private company. Just as a legal disclaimer, this is not solicitation of funds, and I'm not giving investment advice. It's important that you understand this. I'm just letting you know my own thoughts about some of these things. Okay, so there's going to be a lot of content, and that's going to be by design. I hope everybody has notebooks and pens over here, and that any questions, please make this as informal as possible. I really would like to respond to questions that you have and make this a very, very practical session. I'm going to speak for 10 seconds just about the argument of why private investment is a thing. Everybody who's familiar with public markets, private markets work completely different. Private companies work completely differently. So I'm going to just make a quick claim for that. And then we're going to go through the main considerations or provisions in a term sheet. A term sheet is a non-binding contract which an investor enters into with a private company or any company, which effectively set out the primary terms of the investment. And there's two areas of consideration. The one, of course, is economic, which is going to be the majority of my presentation. And then there's the control provisions. And if we have time, perhaps before some questions, I want to speak about the J-curve, which is incredibly important for anybody that is building out a well-diversified portfolio. Okay, so if we go back 10 years ago, you'd see that only 1 out of the top 5 biggest companies by market cap was a technology company. Fast forward 10 years, and not only is it all of the technology companies, but it's actually way more than 5. It's just a bad slide. But probably the top 7 or 8 companies today are technology companies, and these companies are generating an insane amount of wealth for their investors, an insane amount of wealth. And it used to be, if you go back 20, 30 years ago, when a company went public, the private investors could make huge returns, but there was a lot of money left on the table for wealth generation and wealth creation once those companies hit the public markets. Today, that's not the trend anymore. Today, that's not the trend. Private companies are staying private longer. They're investing more resources into them. They're taking on additional private capital from venture capital firms. It's not uncommon to come across these mega rounds of literally billions of dollars being invested into these private companies. And as they stay private for longer and these valuations increase, when they do eventually reach exit, there's very, very little wealth creation that's left on the table. Now, obviously, there is still some. If you look very carefully, you can see that tiny little gray bar over there for the public market. Even LinkedIn was bought, well, it IPO'd at about a $9 billion valuation. In 2016, when it was bought by Microsoft for $26 billion, that's a great uptick for the public market, but it was only about 2 or 3 times their capital compared to everybody else that came in before. So private investing has huge potential to be a game changer in terms of investing and in terms of returns. Okay, so if that's the argument, and if that's really true, how do we find these companies, and how do you get access to these companies? So when we think of what a good investment is, it's effectively just 2 very simple elements. There has to be ample upside that you know that you could get these kind of returns over here. But on the other side, there has to be downside protection. And these are 2 considerations that are of incredible importance. And when we, as a venture capital firm, look at potential startups, of which we see about 200 a month, we choose 2, but we see 200 companies a month. We go through, and our investment criteria effectively revolves around these 6 categories. Now, every fund will have their own provisions, and every fund will have their own checkboxes for diligence, what makes sense to them. But we like to know that there's a great team. Everything's about the team. We like to know that there's technology. We like to know that it's multidisciplinary. We like to see that they're experienced. And a great team that has great traction, and the company's actually doing something, and doing something on a huge scale. We're not looking for niche markets. We're looking for huge markets. We're looking for multi-billion dollar, multi-trillion dollar markets, of which we have a few in our portfolio. We look for a simple value proposition Because unlike a typical fund, we go back to our crowd and we ask our crowd to participate. So if it's too complicated and we could hardly wrap our heads around it, it might be a great investment, but if we can't sell it on to you guys, it just doesn't fit our criteria. And sponsorship, we like to look at co-investors. We like to know that our investment thesis is supported by Sequoia, by Khosla, by Excel Ventures, some of the leading venture capital firms in the world. And finally, deal terms. And that's really today's session. Does this make sense? Is this a good investment? And taking that, I now want to move on to the economic provisions over here. Anybody that's an active investor in our portfolio will know that when we send, even if you're not an active investor actually, anybody that gets our deal flow and has access to the platform can see there's the deal terms. And in the deal terms, you have over there the valuation and the liquidation preferences and all these things. And these are the economic provisions, and we're going to go through these now for the next session, and we'll jump over to the control. And what's important to say over here as well, that everything I'm about to describe only occurs to preferred shareholders, or is only privileged to preferred shareholders. If you buy stock today in Apple, in Google, on any public market, you're effectively buying common stock. And the prerogative that you have at that moment is to say, do I like the valuation? Is it a good share price, bad share price, market cap? That's your choice. You either buy it or you don't. But when it comes to private investment, there are many, many other rights, significant rights, that, dare I say, are actually more important than the valuation, more important than the share price. Okay. Having said that, valuation is incredibly important. And the way we do start off talking about valuation, I think there are effectively 4 levers that we could talk about and 4 ways that a venture capitalist, vis-a-vis the company, can negotiate valuation. And these are the pre-money valuation, the sticker price, we invest in at a $20 million pre-money valuation. The ESOP, that's the employee stock option plan. Liquidation preferences, and anti-dilution protection. Okay, so the sticker price of a company is effectively that number that we think the company is worth prior to our investment. We think the company today is worth $20 million. That doesn't mean that they could probably sell the company today for $20 million. It does mean that we're prepared to buy, let's say, 20% of the company for 20, at that price point. And if you go to your friends in private equity, or you go to your friends in public markets, they're going to say, you know what, look at discounted cash flows and net present values, and it could be a multiple for the revenue. All those drivers pretty much do not exist in startup land. And the reason is because all of our companies don't have revenue when we invest in them. And they don't have traction when we invest in them. And in fact, you know what, they don't even have a proper management team yet because they need the money that we're giving them to recruit those people that are actually going to build the company. So this is not a science by any means. When it comes to startup investing, this is very much an art. It does have some scientific involvement when we look at comps, we look at trends in the marketplace, but that there's kind of an additional factor that we put into the much softer metrics, like the team and the technology and the spirit of the company and where we think the market is going. If you're looking to invest in an ICO today, you're not going to find real comps. The market is so small and so volatile, there's nothing there that you could really peg it to. So the valuation is very much an art, and that we get, I guess, better at by looking at, like I said, 200 deals a month. We've seen now, since our inception, we've seen literally thousands and thousands of deals. We've got experts in each of the industries, I guess, in that we're active. We've got our healthcare specialists that are seeing even more than thousands of deals every year because they're only sending us the ones that they think we'll consider. But as you start to get real deep domain expertise, it allows you to kind of pick out the winners and and identify those early on and you put those valuations. The second propeller on my little drone over there was the ESOP, the employee stock option plan. So an employee stock option plan, again, turns up in every term sheet. The language that you might see when in our deal terms is a $20 million pre-money valuation with sufficient ESOP to allow for a 20% ESOP pool post-money. That effectively means that there will be shares issued to employees of the company up to 20% of the company's stock. And I'll explain why this is important. When you have a startup that is cash, I guess, constrained, which they all are, trust me, it's very difficult to pay them good salaries, to pay your executive team good salaries. They could get much better much better money up front had they gone to bigger, more established companies. The problem is, firstly, there's the cash flow issue, and secondly, there's the whole concept over here of having skin in the game and incentivizing your team, your management team, to be there as long as possible and to take the company from small seeding company all the way up through exit, where there's going to be real growth and real wealth creation over here. So one of the ways you do it, a company will say, you know what, let's reserve some of the shares, right, from the entire pool of capital that we have. And those shares are going to go to our senior employees, to retain staff, to bring staff in, right, the senior people. And the concept over here is effectively to align them. Let them have skin in the game. Let them get into a company that's only worth $20 million today. But you know what? What the hell? If it sells for $100 million, their equity piece goes up 5 times as well. Who wouldn't want to work for a company like that? So it's incredibly exciting. It helps with the psychology of attracting and retaining senior staff. It helps with the cash flow. And more than that, it helps with management as well, because there's a few little tricks that they have over here in a typical ESOP plan, and I'm going to speak about it in the next slide. But one other point over here is, you know, if you're giving 20% of the company away to your employees or to attract staff, that means somebody's losing 20% of the company. And this becomes a tool of negotiation between VCs and entrepreneurs. And that is who is effectively burdening, right? Who's going to shoulder the loss over here of 20% of the company? Is it going to be the investors? Is it going to be the founders? So let's say we get into a company for the first time. Here we go, actually. We get into a company for the first time, and we price the company at $20 million, and there's currently 10% of shares in the ESOP pool. That means of the $20 million value that we're giving over that we would denote into the company, 10% of that, $2 million, is reserved for employees. But as the VC, we come and we say, you know what, we don't think 10% is enough, because you need to get your VP finance in, and you need to get your VP marketing, and we need you to grow a couple of offices overseas. So we just think that your current option pool isn't big enough to support the kind of talent you need on board. So what we'll do is we'll say, we need you to actually increase the pool from 10% to 20%. So we have to put an additional 10% into the pool to get from the 10 to the 20. And that means that we're going to reduce that 20% ownership by the $2 million, being the 10% of the $20 million, such that the effective valuation is $18 million. So the sticker price on the term sheet is $20 million, but effectively as a VC, we only pay an $18 million valuation. And this is one of the tools that we could use when negotiating with a company. The vast majority of the time, it is the existing investors or shareholders of a company that will burden the entire weight of additional ESOP. It is very, very unlikely that we will invest in a company where they say, you know what, invest the $20 million, you want to have additional 10%, that's fine. The minute after you give us your money, we'll do that. Because if we're investors in the company at that stage, and then they put the 10% ESOP, it means that we immediately after our investment just lost 10% of our value because they diluted us that minute after. So what we'll do is we could play with that number, and you know, we could bring it down to 20%, we could bring it up to 10%. Typical will be somewhere between 10 and 20%. 15 is very, very common. If you see more than that, more than 20%, it should be, I guess, an indicator that the company has no management whatsoever today, and we're only investing in technology. If it has less than that, it means that the company is probably a well-established company, doesn't really need to employ more additional talent, and current management has been satisfied. They've got enough shares in the company to keep them happy. So it's certainly an indicator where you could kind of get a feel for the team based on how much shares the company needs to issue to either new or to retain current employees. So that is a very important consideration. Are there any questions on ESOP, by the way? I really want this to be interactive, so if anyone has any questions, I'm going to open it again at the end, but please really just shout out, put your hand up, and I'll be happy to clarify anything, because the goal is that everybody walks out of here being much more educated and, you know, better tools, that when you get more deal flow, you kind of could go through those term sheets and say, makes sense, does make sense, good, bad. Okay. The third consideration that we look at is liquidation preferences. Liquidation preferences is kind of like a LIFO concept in venture capital, that the last money in is the first money out. Meaning that we put money into a company, some of them work, unfortunately the majority of those companies don't work. When those companies have to liquidate at the end of their life, in a bad case scenario, the company raises, let's say, $10 million, and there's $2 million at the end. that could be salvaged, who gets those $2 million? And the rule is 9 out of 10 times, 99 out of 100 times, that it's always going to be the last money that comes into the company is the first money that gets out, because they took on the greatest risk, right? Because the valuation that they invested in effectively was that much higher than all the predecessors that came before. That's the one reason. The second is because they're the ones that are investing. They could invest at that stage in any terms that they want. So long as they're comfortable with it, they'll put that into the term sheet. So the rule is LIFO, the last money in is the first money out. Now, there's 3 types of liquidation preferences. The one is called non-participating, and then you get participating. So of non-participating, this effectively means that, I think there's an example. Oh, okay, I'll come to this. Non-participating preferred means as follows. Let's say we put $2 million into a company, and we own 20% of the company. Okay, the company shuts down, and there's $2 million left to salvage. They burn everything else out, right? And there's $2 million left. We, in theory, get that $2 million. Ooh, I think I've got another bit of time. We get that $2 million out. But what would happen is that's non-participating, mean that you get your $2 million and you go home. As an investor, you've been made whole. And it doesn't have to be 1x, by the way. Your liquidation preference could be higher than that. If you put $1 million in, it might be that you get back the first $3 million. That all just becomes a function of what you'd agree with the company. But effectively, you'll get your money back, and if you're non-participating, you go home. The other scenario is, let's say there's $3 million that's around at the table. We put in $2 million. We could get that money out. We get the first 2, and then there's still $1 million left. What happens to that $1 million? Well, if it's participating, it means that you'll get your money out first, and then you also could double dip. If you have 20% of the company based on your investment, you would take home 20% of that $1 million that's still on the table. So you could actually have a scenario over here in participating preferred, where as an investor in a company that goes down, an unsuccessful company that liquidates and doesn't return capital, you could actually make significant returns. And we see this very, very often in companies that, I guess, are at a pinnacle time in their lives where they haven't got cash, but they're desperate to raise money. And investors will come in with exceptionally draconian terms, and they'll say, you know what, we want to participate, and we want to get 3 times the money before that as well. So you can have a case where an investor will make back 3 times their money, and then participate with anything that's left on the table. This is before some of the other investors get anything out. So it really does land up being a battle between how much of the company you want to take, how much faith you have in the company and its ability to exit. And then finally, the third type is a hybrid between these two, where there's capped participation. We will say to the company, we want to get our money out, but more than that, we want to get our money out plus some, and the company will come back and say, fine, plus some is okay, but let's limit that. As soon as you make back, let's say, 2 times or 3 times your money, that's enough. And at that stage, as an investor, it's time to leave the money for everyone else. So this over here was a scenario that we saw a couple of years ago. There's a company that came to pitch us. The raise was going to be $15 million, of which we were leading this, and we were unsure how to structure the deal. We were either going to value it at a $60 million pre-money valuation or much higher at $110 million pre-money valuation. And the terms were going to be different. In the first scenario over here, we would have had 20% of the company and only a 1x liquidation preference. In the second scenario, we would have held less of the company, but we would have had a 2x liquidation preference. Okay? And what's fascinating over here is on a $15 million investment, we would have got back in this scenario with the 1x liquidation, $15 million, in the second, a $30 million exit. And when we try to compare where we thought this company was going, what the likelihood of an exit was going to be, what becomes apparent is that at the $150 million exit value, that's really the point of indifference. But anything less than $150 million exit, we would have been more satisfied to take the 2x liquidation preference, even though we're owning less of the company, because up until that pain point, to that exit price, we would have made back more money with the liquidation preference than values larger than that, where we would have made back more money by having a higher stake in the company. Okay, so these over here are some of the considerations that we'd also look at, which is where do we see the exit, the likely exit? What do we think the risk factor is in this company's ability to exit? So that's with regard to liquidation preferences. And then the final and fourth propeller on the drone of valuation is anti-dilution protection. Anti-dilution protection is an incredibly important term. again, that you should look out for in all of the term sheets. This effectively means that any company that raises capital, raises equity at a valuation or a share price less than what you paid as an investor in a previous round, you get protection. You get protection in that heavy, heavy dilution that comes from this much cheaper issuance of equity. And again, this is a particular right that only preferred shareholders have. There's effectively 3 types of anti-dilution protection. And you'll see this again. Most common is weighted average broad-based protection. Full ratchet, though, just to start with that, is very rare, although there are some scenarios where we do try to use it quite often in our term sheets. Full ratchet means that, let's say I put money into a company at a particular valuation that denotes $2 a share. And then 6 months or a year later, you guys come and you invest at a valuation that, calculates out to $1 a share. My entire investment will be recalculated to your share price. Effectively meaning I will now, in that scenario, get double the shares that I previously had to offset the dilution. So anytime there will be shares issued at a price cheaper than mine, I will get those additional shares to offset the value, to offset the dilution. Okay? Very rare because it's seen by the entrepreneur and the startup perspective as being incredibly draconian, and that's not the kind of partners they're looking for. They're looking for people that understand that it's a risky asset class, and sometimes things happen and they have to take cheap money. But that certainly is something that we will do, and we incorporated this more and more into our term sheets to say, for the first 6 or 12 or 12 months, we want to have full ratchet, meaning that we've done all our diligence. We like the company. We think there's tremendous opportunity here. But if you guys are pressed against the wall and you have to raise money relatively soon after our investment, it means that something wasn't disclosed fully, or something was not caught through our filter, and we want to make sure that we're compensated for that scenario. Excuse me, and we'll make sure that we have the full ratchet for a limited time period before it then flips out to broad-based. Broad-based has a ridiculous calculation that's complex, but it effectively means that it will take a kind of average between the amount of shares that you bought, how many shares were in the company, how much stock in general has been issued to the company and to all the previous rounds of investors, and it will kind of come to a balanced average such that the investors get made partially whole, that the previous founders in the previous cap table doesn't get the full load of that rebalance. So a much fairer kind of way to do things. You will not see any term sheet from OurCrowd that does not have some sort of anti-dilution. At least if we're talking about a preferred investment, we have made 3 investments in common stock. But for the majority of our portfolio in preferred shares, you won't find a single one that does not have anti-dilution protection. Okay, so that kind of finishes the section with regard to the valuation and how we try to get comfortable with the valuation. Yes, sir.
Questions on liquidation?
Yes, sir.
Who decides how and when to force liquidation? Second is, do you actually invest in companies you expect to fail, expecting that 2 or 3x return, and looking for that?
So the question was twofold. Number one is who decides in a liquidation and when to shut a company down? That is typically the board. The board will instruct or agree, right, and then go back to the shareholders and recommend to the shareholders to shut down the company. And they could do that. Typically, the investor sits on the board anyway, so kind of wearing the same hat. But it will be the board of directors that will shut down the company. The second question was, do we invest in companies with high liquidation preferences? Correct me if I'm wrong. Do we invest deliberately in companies with high liquidation preferences, knowing that they will probably fail just so we could take advantage of the liquidation preference? No, we don't. We don't. Unfortunately, sometimes that happens. Or if we are already invested in a company and we feel that they just need one extra push, and if we give them an extra $500,000, they're going to make it or break it. So that money that's at risk will have a high liquidation preference. But of course, our incentive over here is to invest in young companies that grow up to be big, strong, healthy companies. We're not looking to flip a coin and to try to get rich quick. This is very much a long-term strategy for us. Okay, another consideration, which is probably the most important term in a term sheet, more than valuation, more than liquidation preference, which, as you understand now, is the most important in terms of downside protection. When it comes to the upside, liquidation, preemptive rights is of incredible importance, because effectively, as companies grow in their value and their wealth, what you want to do is make sure that you own the same amount, or at the very least the same amount, but really double down on those companies and own as much as possible. A small piece of a big, big company is worth a hell of a lot of money. So what you want to do is try double down on the good companies and make sure that every time a company is raising more money at a high valuation, to be able to participate with your pro rata. So if you have 10% of a company and the company goes and raises another $10 million, if you put in 10% of that $10 million, you effectively avoid all the dilution and you stay where you are. So for our current investors, you'll know that every time one of our companies does a follow-on round, we send an email out to let you know that you invested $10,000 a year and a half ago. The company now has a new term sheet from whichever VC. Here's an update about the company, what it's done and achieved over the last year or so, and your opportunity to participate in the round. And based on the merits of that the company has achieved, to double down, to do more than your pro rata, right? We're not anchoring you to a number, but certainly to letting you know that if at the very least you want to avoid dilution, at the very least you should be participating with your pro rata. And this is why there's this concept in VC called the power law. And the power law, if you take nothing out of here, just remember this slide and the next one that comes. The power law says as follows, that there is a misconception that there are linear returns when it comes to startup investing. You're going to have some companies that don't make it, some make it a little bit more, some a bit more than that, and some will, be your Facebooks and your Snaps, and they'll, return your portfolio. But the truth of the matter is that that is completely incorrect, because what you really find is the power law. The power law comes and states that 1 or 2 companies in your portfolio will offset all the losses along the way of all the others. And we've seen this in our portfolio, we've seen this time and time again, and there's so much research on this that all it takes is 1 or 2 companies to return all the losses of everything else. I'll give you a real life example. Back in 2010, Andreessen Horowitz, which is one of the premier VCs out of the West Coast, gave a $250,000 check to a small company called Instagram. Okay. $250,000 for Andreessen, by the way, is a tiny check. It's probably not worth their while to get the people together to sign the check. It's a minute check for them. It doesn't justify the portfolio and it doesn't justify the investment thesis. But this is all Instagram needed, was a seed round. They put $250,000 in. 2 years later, Facebook buys that company for $1 billion. Andreessen gets a check back for $78 million. Okay, so when you put in 250, and if you were, by the way, to try put that across a portfolio of 20, 25 companies like that, it kind of explains itself why the power law is so real, where you have very, very few winners that offset all the losses of the others. So let's say they had 20 companies in that portfolio and they put $250,000 in all of those companies, they would have lost $5 million in the bad companies. They made back 78. So the power law is very, very real. So when it comes to preemptive rights, it's very, very important to understand that when you're able to understand where your winners are emerging from, right? So that's where you want to double down. That's effectively where you want to be able to put in as much resources as possible and reserve the capital on those companies that are failing and not going anywhere to make sure that you are better positioned to have those capital reserves for your winning companies. Okay. Shifting gears completely now and leaving the world of equity investing, we have this other concept that's out there that is debt, convertible debt. Convertible debt is, I guess, a way of delaying all the discussion about valuation. It's a way of delaying all the discussion around liquidation preferences. And this effectively comes and says, and it's cheap, by the way, cheap and quick to get done. An investor will come to a company and say, you know what, we'll give you money. It's debt. It's going to convert at the next round that you do that's led by somebody else. We don't want to lead it. We don't want to give you a valuation. We either not interested, don't know how, conflict, for whatever reason, it's too small for equity. We will give you money today, and it will convert on the following terms. Either at a discount in the next round. So let's say somebody comes and values the round or the company at $20 million. So if you're going to get a discount, you'll pay less than the $20 million valuation and obviously a smaller share price, or you'll have a cap. And what we try to do in our term sheets is actually go to these companies and say, you know what, we're going to convert at the lower of the discount of the cap. Meaning that let's say there's a cap of $15 million in a company, so meaning that we will never pay more than $15 million, and there's a discount of 20%. and the company goes and raises money at a $10 million valuation. So if that's the case, we'll say, you know what, forget the cap, we're taking the lower. We would convert at the 20% discount to the price round, which was 10. So we will convert at an $8 million valuation. Everybody else will invest at a $10 million valuation, and the cap is moot. On the other side, and we've had this now scenario, we had a particularly low cap. The company did remarkably well. We had a cap of 20. They raised money at $40 million. Everybody put money in at 40. We were capped at 20, and effectively we had a 50% discount on the round. So we try to play these, play these together and off each other. The problem, by the way, with the cap is sometimes it does give marketing expectations to the outside world that any investor that comes and looks at the company and looks through the data room and sees what contracts are out there and sees that there's a cap. Sometimes it does signal to them what the company's valuation is, because when we put the cap into our term sheets, of course, it's calculated, and there's method to our madness of why we decide to do that. So convertible notes, very important. And finally, the last piece of economics is the right to convert your preferred shares. You have preferred shares and common shares. The preferred shares get their preference. The common shares get their piece of the pie. Occasionally on the liquidation preference, it's uncommon, but you do get that concept of participating preferred, where they get their preference and they also get to participate. It's rare because, like I said before, it seems to be very draconian. But if we were to understand, you have your preferred shares with their preference, and you have your common shares with the participation or the pro-rata. So in this particular example, let's say a company raises $5 million at a $15 million valuation. That means the post-money valuation is $20 million. And if you put $5 million into that post-money, you as an investor own a quarter, you have 25% of the company. When the company gets sold for $40 million, the liquidation preference, in this case, the terms over here were 1.5 times the money. So if you put $5 million in, you get the first $7.5 million out, and you go home. The other option is, though, to convert all your preferred shares, say, I'm losing all my rights to the preferences. I just want to have my piece of the pie. And if you have 25% of the company that sells for 40, you'd much rather take the 10 over the 7.5. Meaning, and this is very important as well, that and maybe we need to be better, by the way, when we put our term sheets out and we try to communicate the deal terms to our investors. When we say that there is a 3x liquidation cap, we are not saying by any means that your total upside is capped to 3x. We're saying that the preference shares are capped at 3x, but any scenario where it makes more sense to convert into common and go up to 4, 5, 10x, 50x, there is no limitation. So the upside in VC investing is to the sky. The downside is protected, though, by the liquidation preference. So going back to my first slide, when we look at a good investment, what we really try to do is balance to make sure that there's ample upside and that there's very limited downside exposure, or make sure that we can increase those protections as much as possible. You won't find a term sheet from OurCrowd. I don't think you'll find a term sheet from any sophisticated investor that does not have the option to convert. We're in this game not to make 3x. We're in this to try find those Facebooks and Instagrams and Snaps. So any type of term that limits the potential upside on a company will hurt our business and hurt our economics. That summarizes everything with regard to the economic provisions. But on the other side of the coin, on the other side of the term sheet of not significant less importance, is also the control provisions. And the control provisions effectively come and say, I'm giving you the money now, who gets to say what happens with that? Okay? And these provisions over here will say who sits on the board. Not only who's sitting on the board, but what rights do we as shareholders get to extract information from the company. So at OurCrowd, we make sure that we have full information rights. At any moment, I could go to my portfolio companies, make them open up the books, full exposure to revenue, full exposure to all their expenses, to their burns, to the minute detail, to general ledgers. In fact, we had a scenario back in 2015, and I'm saying this for the to try to highlight the importance of this term. When you invest in a company, you try to pick out the good people, you try to pick out the good technologies and the partners. We had a company where, unfortunately, there was a bad actor, and not very shortly, about 9 months after we made our investment, I could already sense that money was missing. The balance sheet just didn't look as full as it should have based on where we thought the company was spending money. And because of this right, we compelled the company and the CEO to let us full access into their company. And we discovered that there was actually some foul play over there. Money was fully returned. Investors were made whole. There was a coupon put on it as well. But without having that ability to actually get into those companies and see them, you're kind of in the dark like you are in a public stock. So information rights are very important. rights of first refusal. This means that, let's say a company is looking to sell itself. If you find that you are a strategic buyer, or if you know somebody that could do that, before they go to a competitor of yours, you get the ability to buy that. You have the ability to first put down the right of first refusal. You could first buy that company or other transactions, not only M&A, but anything that makes sense for you to do as a shareholder, you could do prior to going to competitors or prior to doing anything else. And then finally, protective provisions. Protective provisions, again, very, very important. We luckily have not had to use any of these provisions in our portfolio that much yet. But this, for example, will forbid a founder from selling their shares in secondary markets. We don't want to be in a situation where we put money into a company, the founders then go and sell all their shares, they have no skin left in the game, and we're left with an unincentivized founder. We're left with people that don't really care about the economics because they just got liquidity. We want to make sure that we can limit founders selling shares. We want to make sure that we limit the company raising more money at valuations that doesn't make sense to us, or that hurts us, or that they'll be able to replace us from the board and take us out of. So we make sure that, and the whole purpose over this over here, these terms, is to eliminate the ambiguity and to make sure that there is no argument when these issues come to the fore and say, we've already discussed this, guys. We've already agreed a year and a half ago what's going to happen in this scenario. So it's kind of avoiding the argument and making sure that, we don't have any of these issues going forward when it actually does come to the fore. Okay, and then finally, just with regard to portfolio structure, I'm going to just jump to this over here. The J-curve is, I think, one of the less spoken about features of a healthy portfolio, but it is very important for anybody that's investing in this asset class, which extremely risky asset class. So one of the questions I get all the time is, why should I invest more in VC if I could see, I made already 4 or 5 investments. They're not showing any signs over here of growth. In fact, my net present value today is less than it was, right? It doesn't make any sense. My portfolio NAV is down. Why would I continue to invest in you guys? And I want to make 2 comments over here. Number one is that when you invest in a fund, any fund, not OurCrowd, when you invest in a fund and the fund managers take in fees, typically 2% a year for the life of the fund. So a fund that's 10 years tenor, right? That's 20%. You could immediately write off 20% on the day that you sign the check because that money goes to management fees. So automatically, any money you put into a fund will immediately have a negative NAV. In addition to this, and this is now the most important part, the worst companies in your portfolio, your dogs, are going to die soon. They will die first. They'll die before your better companies expand and grow. And that's just the way it is. Companies with no money shut down and die quicker than companies that have money. So if you look over time, what you would find is that the worst companies in your portfolio, they already start to get written down. This is when they run out of cash. This is when there's nothing left. And this is when they're written off completely. But Instagram and Facebook that you invested over here in that big round over there, they haven't changed their valuation because they haven't had to raise money. Because that they're doing is something unique to a few startups that not many could do, and that is they generate revenue. And when you've got revenue, you don't have to price your company. You don't have to go back to equity markets because you could just use that working capital. One moment. You could just use that working capital to actually fund the operation. So what you would find is that the better companies just take longer and longer and longer to grow themselves. They mature. And then eventually, once all the dogs have died, it's these companies that actually start to shine, and they're the ones that return the NAV. So what you typically find in a fund is that that point of inflection between negative to positive happens on a 10-year fund around year 5, 6, 7. That's where it's typical. Year 8 to 9, you start to see some exponential growth. Yes, sir. Okay, great. Yes.
Approximately, what would be the longest time frame you would be looking at, and what would be the typical for a fund IRR?
The first question is much easier. It depends on the stage that you invest in the company. The question was, what is the typical time frame that we could expect to see this happening? It depends on the investment thesis of the fund and where you're investing. A fund that's investing in later stage or growth rounds, they would have a much shorter time to exit because they would typically be looking to put money in, get those private equity funds to come in to pick them up and to sell them out. If you're investing in a seed round, so those are going to take much, much longer. And of course, there's a higher chance of those companies of dying because the risk is so much higher in the seed companies. So it really depends on where the investment thesis is, which type of asset class within startups you're looking at. If you're looking at the seed, the A, the B, the growth stage companies. I'm not familiar with any specific rules on that, or I haven't seen any type of literature that spells that out. Remind me the second question?
The normal IRR that you would expect.
A fund that has 10 companies will probably not return much money. We'll find this over here has been done extensively across multiple funds, multiple GPs, in multiple geographies, right? What they found is that having less than 25 companies in a portfolio is 25 companies rather seems to be the point where you could start making significant money, 3x your money. A fund that returns 3x net to its investors over 10 years is great. That means the fund has to make 4x on its gross investment in order to make sure that there's reserves for the carry interest that they pay to the fund managers, which lands up being about 20% typically. So a fund that could return 3 times its money over 10 years would pretty much be the bell curve. And that takes me, I guess, to the summary now. The 4 points to take home. Number one is that the valuation sticker price is just one small component of how we price a company. There are many, many other factors that go into it. Don't get stuck on it. We've actually had companies that have come to us and said, hey, great news, Shmuel. We've got a term sheet from another VC. It's a big up round. You guys invested at a 20 million valuation. This is a 30 million valuation. But because of the ESOP and the liquidation preferences, the effective share price is lower than the share price that we participated in and we invested in. So it's one of those things to look out for, that don't get stuck on the valuation, on the sticker price. The other thing is diversify. If you invest in one company, trust me, you'll lose your money. If you invest in 100 companies, you'll make money. Somewhere in between, there's the right number that makes sense, but you have to diversify in this asset class because the chances are that one company, unfortunately, is not going to be Instagram. The third is that, like I showed before, this is a long-term game. It takes time. It's going to be frustrating at the beginning as you see some of your bad companies are starting to get more attention, and we're starting to put up red lights around them to let you know that, I'm sorry you invested, it's not happening, it's not working for that company. That's just the nature of the game. You just have to be patient on the winners. And finally, make sure that you take advantage. That's not investment advice. Make sure that you consider the pros and cons of doubling down in follow-on rounds when those companies are starting to emerge and those companies are starting to show signs of real growth and value creation, to make sure that you don't get diluted and that you put in your piece of those rounds as well to make sure that you're relevant in that company when it does exit. So I'd like to open, looks like there's another 10 minutes for questions. Yes, sir.
You said the term sheet is a non-binding document.
Correct.
What does non-binding mean?
Non-binding means that we could sign a term sheet today and tomorrow change our minds and say we're not doing the deal for whatever reason. It's bad for us reputationally because startups want to know that once they've gone through a process with your firm and you've signed a committed document that you're going to invest, what that effectively does is allow you a 60 to 90-day window to conduct all your diligence in the company. It's looking through all the contracts. It's getting the legal teams involved. The term sheet effectively is the skeleton document that you will use to create your 200-page document, which is the actual transaction documents. So it is completely non-binding. What you'd find many VCs actually publish on the website the successful chances or the percentage of closing deal terms to actual investment. So they'll say typically we've closed 97% of our deals, right? Meaning that this is indicative that unless we find a skeleton in the closet, you guys can know that once we sign on this piece of paper, we are going to go through with, and that's actually an important point because in the deal terms that we put on our website, we do say over there that's subject to change. And if there's a critical change that we think we need to convey to you, we'll do that. If it's a non-critical change, we're obviously not going to tell you that. But the term sheets that we sign with companies are, in theory, subject to change. Yes?
You talked near the beginning about the science versus the art of valuation.
Yes.
On the science side, you talk about DCF and NPV. Can you just talk a bit about some case examples where you used a different discount rate for two different investments that you made and why you chose?
Sure. So.
Analysis of where you got to the discount rate of choice about.
Sure. The question was with regard to discount rates and how we would calculate those and which discount rates to use. So the point I was trying to make is that we actually don't use discounted cash flows there. I'll give you an example. A couple of years ago, one of the companies that we got very deep down the road with, they sent us their business plan and startup seed stage. They were expecting to be doing $74 million in revenue by year 3. I'm looking at the Excel whenever I see $74 million in year 3. That already means that there's a problem with this company. They haven't thought things through because it's not that easy to make $74 million. And I saw what the founder had done. He had created his 1-month projections. He had used a, guess, conservative in his eyes, 6% growth. And he had just taken Excel and he had just drawn it out for 3 years. And that's how he gets to $74 million. I still didn't understand like why the heck he'll be doing that. So I called him up and I said, there's actually a mistake in the formula. Look over here in column whatever. And he says, oh, you're absolutely right. He sent it back, says, there, now it's fixed. He fixed the Excel and he went from $74 million in year 3 down to $14 million. So he said to me, there you go, it's now fixed. I said, but aren't you concerned that your business is broken? You just lost $50 million of value to your shareholders. That's the point I'm trying to make, is that discounted cash flows do not work in this regard. The general rule, and I mean, my job, by the way, just I guess in a functionary purpose as well, is that I look at the business plans. My background is I'm a trained accountant, so I look at the business plans and I try to give advice to the investment committee on what makes sense and what doesn't. The rule of thumb over here is that companies will burn way more money than they're telling you, and they will take much longer to generate revenue. If they do generate revenue, then they're expecting as well. And we take that into account. When they say to us it's worth 5 times their revenue for the next year because this is what the other companies have just raised at 5 times their revenue, so look at those comps, you should price us the same. We don't believe them with the revenue, and we don't think this is enough cash. So we definitely take that into account, and we discount those kind of conversations with the founders, and we're very frank about it. We try to let them know that, it's just not going to be that easy. When you think that you're going to penetrate North America and within the first 6 months you're going to be having 20 guys on the ground selling 200 grand a month, it's just not happening.
So then when you look at the art side of it, you're looking at the team and the market and the simple selling point, the sort of story behind the company. And how do you, as an art, then obviously decide what is a good value for the company at that stage?
Absolutely. So how then do we focus on the art? There is no figure. That example that I gave where we're going to put 15 million either at 60 or 110 was actually a real example. It was a real example of a company we're looking at, and it could have gone either way. In fact, I remember just a few months ago, I was sitting with John Medved around the table, and this company was pitching, and John said, I don't know if your company is worth $1 million or $100 million, because the technology was either so real or so ridiculous. So at that stage, we elevated. We go out to our domain experts. And we'll say, have a look at this. You've been doing this for 20 years. You started 4 companies yourself. You sold them. You sit on the following boards. We feel that you have domain expertise and we could trust your opinion. We value your opinion. Let us know what you think about it. And we also have a professional HR firm that we work with. And before we make investments, we say, you know what, you need to spend a couple hours with her and let her give us an assessment as well on where we feel you fit in the spectrum of good entrepreneur, less good, you know what I mean? So we definitely try to, it is definitely an art. It's an art, and through seeing so many companies, we do try to kind of get towards a number that we're comfortable with. And then when we put that out, again, the crowd could assess that for themselves and think, does it make sense to them or not? Time is finished now. We do have, I'll come back to now, there's a 20-minute coffee break. The next session, by the way, is for anybody that'd like to stay, starting in 20 minutes, is all about how to onboard onto the OurCrowd platform, how to get involved, how to sign up, and it's going through our head of investment relations. I'll stick around here anyway if anyone has additional questions.